The quality of loans in 2020, it has no comparison whatsoever to the quality of loans we saw in 2005, 6, 7, and 8, leading into the Great Recession. Historically, about 1% of loans go into foreclosure in any given year. Right before the pandemic hit, we were actually running at about 0.5%. So we were running 50% below normal historical levels of foreclosure activity, which to me is an indication of a very high loan quality. And that, again, is one of the aspects of the Dodd-Frank legislation. At the peak of the foreclosure crisis back in 2010, 2011, we had about 4% of borrowers who were in foreclosure. So it was a nightmare in terms of the sheer numbers and the size of the problem. And Dodd-Frank really wasn't set up to anticipate a global pandemic.
No.
It had an impact on making sure that when one hit, the lending industry, the loan market, if you will, was very, very healthy. The other thing that'll be interesting to see as we come out of the pandemic is all the regulations that were put in place after the Great Recession. To try and give borrowers the opportunity to work out something before foreclosure will kick in.
You are listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth. Hello, I'm Deidre Woollard, editor of Millionacres, and this is the Millionacres Podcast. Today we're talking about something that's been on my mind a lot lately, which is the possibility of a rise in foreclosures. So right now, foreclosures are still low in this country. There have been a variety of government interventions to keep people in their homes, but a lot of people say they're postponing the inevitable. I feel it's a complicated situation, one with both positives and negatives for real estate investors. It's kind of impossible to predict the future of the housing market. I don't have a crystal ball, but I believe that looking at the data gives us a window into potential trends. So that's why I'm here today with Rick Sharga, who recently rejoined RealtyTrac, which some of you have probably heard of. It's a foreclosure search and listings portal. And Rick has had a long career in real estate and mortgage industries. He's seen these cycles before, so I'm excited to really talk about the numbers and get a little more clarity on what's happening now and, more importantly, what could happen in the future. So welcome, Rick.
Thank you, Deidre. It's very nice to be here.
So you've come back to RealtyTrac at an interesting time. So what are you seeing in terms of the potential for a new foreclosure cycle, and how might this one be different?
That's a great question, Deidre. And you're right. It's not a coincidence that I came back to RealtyTrac when I did. The company's owners believe there will be an increase in default activity over the next couple of years. And it seemed like a good time to relaunch a brand that's known for participating in the foreclosure market. Having said that, I don't believe we're looking at a huge wave of foreclosure activity that's going to hit us imminently. As people that have been in the mortgage industry for a long time will tell you, it's much better to work with a borrower and try and avoid a default than it is to work with a borrower once they've defaulted on a loan and try and remedy the situation. And what's really encouraging this cycle compared to the last cycle, compared to what we saw in the Great Recession, is the government stepped in to try and intervene and create this forbearance program, the moratoria they put in place that are intended to give that borrower enough time to get back on his or her feet and the economy enough time to recover so that there are jobs available and we can keep people from losing their home to foreclosure. What's also been gratifying is to see the industry work hand in hand with the government to put these programs in place so quickly and execute them so well that we're keeping literally millions and millions of people from losing their homes unnecessarily.
Well, I think that's a really interesting point because we've got two sets of government programs, because you've got all of the programs that came into place after 2008. You've got Dodd-Frank and things like that. And those, I feel like maybe this is the first big test of programs like that.
In a way, yeah. And in a way, it's actually a validation of what Dodd-Frank was intended to do from a lending perspective. Mm-hmm. The quality of loans in 2020, it has no comparison whatsoever to the quality of loans we saw in 2005, 6, 7, and 8, leading into the Great Recession. Historically, about 1% of loans go into foreclosure in any given year. Um, right before the pandemic hit, we were actually running at about 0.5%. So we were running 50% below normal historical levels of foreclosure activity, which to me is an indication of a very high loan quality. And that, again, is one of the aspects of the Dodd-Frank legislation. At the peak of the foreclosure crisis back in 2010, 2011, we had about 4% of borrowers who were in foreclosure. So it was a nightmare in terms of the sheer numbers and the size of the problem. And Dodd-Frank really wasn't set up to anticipate a global pandemic.
Yeah.
It had an impact on making sure that when one hit, the lending industry, the loan market, if you will, was very, very healthy. The other thing that'll be interesting to see as we come out of the pandemic is all the regulations that were put in place after the Great Recession to try and give borrowers the opportunity to work out something before a foreclosure will kick in. So even if we do start to see an increase in foreclosure activity, it probably won't be anytime real soon. In fact, the regulations put in place would lead me to believe that you might not start to see any increase in foreclosure activity until maybe mid-2021 or later.
Wow, that's really interesting too, because there's been some criticism of forbearance. You mentioned it a little bit before, and whether or not is it postponing the inevitable, or is it giving people that chance to catch their breath, to for the economy to pick back up, for jobs to pick back up. And so I think that's one of the things that we don't know right now.
Well, we don't know exactly how it's going to end because we haven't seen this particular movie before.
Yes.
But here's what I can tell you. The loans in forbearance are actually performing better than you would expect. So there was an economist on the East Coast. I won't give him any credit, mention his name, but he was predicting that 25 to 30% of borrowers would wind up in this forbearance program. In my back of the envelope math tells me that would have cost the mortgage servicing industry about $90 billion over 6 months, and would have essentially bankrupted the system, making it impossible for anybody to get a loan. That never happened. We peaked at about 8% of borrowers in the forbearance program. A survey from LendingTree suggested that about 70% of those borrowers didn't really need to be in forbearance, but they'd opted in more or less to hedge their bets just in case their financial situation worsened because of COVID-19. And we've actually seen 25% of the people in the forbearance program continue to make their monthly mortgage payments. So think about that. About 1 million people in a forbearance program who don't have to make a mortgage payment have continued to make one every month since they entered the program. So that tells me that the people in forbearance aren't necessarily in the dire straits that the raw numbers would suggest they are. Two other little tidbits for you. One is that the number of borrowers in the program peaked the first month. So at the end of March, we saw a huge spike. A lot of people opted in. I would submit to you that if the situation were continuing to get worse, we would have seen a similar spike at the end of April, the end of May, the end of June, the end of July, the end of August, when the next month's mortgage payments were coming due. Instead, what we've actually seen is every week, fewer and fewer people in the program. And that's continued consistently since the end of March till today. The other thing to point out is that as people leave the program, and they are leaving the program, less than 10% of them are going delinquent on their loans. So if that holds, it really does give us a reason to be optimistic that the borrowers exiting the program will revert back to being, performing borrowers, making their payments on time as they move forward.
So I find that really intriguing. Do you think that people were sort of just getting into forbearance as a precautionary measure, or just because they kind of panicked and thought, okay, I don't know what's going to happen, so I should do this?
Well, let's be candid here. Let's be realistic. There are probably a large number of people in forbearance who really did need forbearance.
Right.
They lost their jobs or their income was diminished. I do believe there are a lot of people in the program who did it as a safeguard because they really weren't sure what was going to happen. And if they could get into a program that would give them this kind of protection, why wouldn't they take advantage of it, even if they didn't necessarily need it. And then, honestly, there are probably people in the program who knew they weren't going to need it, but thought, hey, this is a great way for me to salt away the cash I would normally be spending on my mortgage and use it for something else, whether it's to pay down debt or, build up their cash reserves or invest elsewhere. So there are always some people that will take advantage of a program when they have the opportunity to do so. And this program was purposely set up to make it easy for people to get into because time was of the essence. So you didn't have to go through this rigorous screening process to qualify for the program. You had to raise your hand and tell your lender that your income was being affected by COVID-19. And that's all you needed to do to qualify. So there's always some people that will avail themselves of those kind of financial opportunities when they can. Let's put it that way and leave it at that.
So do you think that because of the current low rates for mortgages that some people may have opted to refinance instead of going into forbearance and maybe lower their payments that way?
Well, that's an interesting question, Deidre. And one of the things I think some borrowers miscalculated was that they'd be able to refi out of the forbearance program. And in fact, a lot of lenders are very reluctant to do a refi loan to somebody who's asked for forbearance because they're not sure what their financial situation really is. So people are leaving the program and it takes them a month or two to get their finances back on track so that the lenders will offer them that. But what I am seeing is a surprisingly large number of people exiting the program are paying off their loans. So either they're terming out, they're selling their property, and there's a huge market demand for housing right now. So selling a house is a great option. And there are some that are refinancing as well. And those low interest rates are making it a very attractive option, a good way for people to lower their monthly mortgage payments, and also to a certain extent driving that demand for home sales.
So obviously, there's not a lot of foreclosures out there, but I did see that third quarter report from Adam Data about zombie foreclosures and the reason that we might be concerned about those. So can you explain for people a little bit about what a zombie foreclosure is and why we need to keep an eye on that?
It's funny that we came up with the term zombie foreclosures when I was at RealtyTrac the last time. So I'm surprised that terminology has lasted as long as it had, but we're coming up on Halloween, and so we may as well dust it back off. A zombie foreclosure is a property that's in some stage of foreclosure, but has not yet been auctioned off and sold to an investor, or has not yet been repossessed by the bank. And the process has gone on long enough that the borrower has abandoned the property. So now we have this property that the borrower is no longer maintaining. They've abandoned it, it's vacant, but the lender can't take possession of the property because the foreclosure hasn't been finalized yet. And this really came about because of some well-intended legislation in states like New York and Florida that extended the foreclosure process in an effort to protect the borrower and give the borrower more leeway in terms of how long they had to try and remedy the situation. But unfortunately, it's extended the program so long. In New York, for example, it can take up to 3 years to do a foreclosure. Which means you could have somebody living there essentially rent-free for 36 months. And we've seen borrowers just leave because they're done. They want to move on to the next stage of their lives. And the courts have not allowed the lenders to repossess the properties until you go through the full cycle. So one of the unintended consequences of the current government moratoria on foreclosures and evictions is that there were properties that were already in foreclosure when the pandemic hit that are now in limbo. They basically are frozen in place, but it's been 6 months since these moratoria were put in place. So imagine a property that's been in the foreclosure process for a year already. Now you tack on 6 months of really this kind of limbo period, and borrowers are leaving. And so what we're finding is more and more of these foreclosure properties are going vacant. That makes them certainly a contributor to neighborhood blight. Vacant properties are always a safety hazard for the neighborhood. And I would submit to you that in time of a global pandemic, they become even more of a safety hazard, just because of the health concerns that you have that you wouldn't have during a normal cycle. So it's not a huge problem. There aren't millions and millions of these properties, but in certain places, New York, Florida, some parts of Illinois, you do see a number of these, and it's a situation that really does need to be cleared up.
Well, and I remember during the last foreclosure crisis, there were different cities that were working on boarding up the ones that were vacant and things like that, and sort of or maintaining the grounds. And that was obviously a concern because just one house in this situation can have a huge impact on how it on a neighborhood and property values.
Normally, we'd see municipalities step in,
Mm-hmm.
but state and local governments right now are in dire need of revenues because of the recession that's been brought on by the pandemic and the subsequent government shutdowns. Tax revenues have fallen through fallen into a gully. So municipal governments really don't have the cash to go out and kind of take care of these properties. It's not as high a priority as you might think in normal times. So this probably couldn't be happening at a worse time in terms of local government's ability to take care of the problem.
That's true. And one of the things that I've been watching a little bit is property tax easements, and some municipalities have pushed back the dates or given people a little more leeway in paying property taxes due to COVID-19.
Yep. Yeah, that's happening. And look, the real estate is a big part of the revenues for most municipal governments. It funds school systems. It will be really interesting to see how this all plays out between now and when we can put COVID-19 behind us. But I think from a budgetary standpoint, it's going to be a while till people recover.
Exactly. So I wanted to pivot a little bit and talk about the opportunities for real estate investors. Obviously, right now we're in this really sort of crazy real estate market that just sort of has I think everyone a little bit baffled because we've got this huge demand. Inventory is just so low. Prices have been going up in a lot of markets. And, at first people were thinking it was pent up demand. And now it just seems to be something else that's kind of going forward kind of as its own right. Do you think foreclosures are going to sort of equalize that market, or you said earlier that it's going to be a long wait? So is there no hope in sight?
Well, it's so weird to have us talking about no hope in sight during the hottest housing market in 100 years, right? So, and that's not a bad thing. I understand your point from an investor perspective, though. There are really two things driving current demand, and then there's some accelerators. So one is these low interest rates we talked about. We hit another all-time low yesterday on 30-year mortgage rates. So, the notion of having a 30-year fixed rate mortgage at 2.5% is just, for some of us who've been around for a while, that's mind-boggling. My first mortgage actually had 2 digits in front of the decimal. So I go back that far. I think I invented mortgages. The other thing that's driving demand is millennials. And we've been talking about them forever. I was one of the few contrarians who said that millennials actually were going to buy houses at some point. And I've been saying that for years. They're doing it later. And so the prime age for a first-time home buyer today is about 35 years old, which is probably 5 or 6 years older than what it's been historically. There's a huge cohort of millennials that are in the 32 to 34-year-old age bracket and moving quickly toward that first home buying age. And really, that's the other thing. So demographics and low interest rates are what's driving demand. The pandemic, in an odd way, has actually accelerated millennial home buying. And what we had already been seeing is a movement from urban renter to suburban homeowner. The pandemic has really accelerated that dramatically in major urban markets. Apparently, being quarantined in a 700 square foot apartment with a toddler wasn't as much fun as everybody expected it to be. These millennial families are moving not out just to the suburbs, but to the far suburbs, almost into rural areas, because now they're not worried about a commute back into work in the city because they're going to be able to work from home in large numbers. They're also looking for a larger property because they want a home office that they can use. And they want space between them and their neighbors so they're not in this population density model that's been so problematic for cities during a pandemic. So we're seeing a lot of that activity, and the builders are responding to that and starting to build in suburbs and far suburbs. There will be more delinquencies, there will be more defaults, there will be more foreclosures over the next couple of years. Let's do a make-believe timeline. The government forbearance programs give you up to 6 months with an option of another 6 months. So conceivably, a borrower could be in forbearance until next March. Theoretically, they probably won't be in large numbers, but it could be next March. When you exit the forbearance program, your loan basically goes from being really, really delinquent to current automatically. And they take the past due, they take the missed payments and plug them into the end of your loan. So you're now current. If you're a borrower who is in forbearance, you're now current, and you lost your job and haven't gotten a new one, it's going to be 3 to 4 months before you actually get your default notice of missed payments. So that's summer of 2021 when you go into default. And in most states, it's going to take at least a year to go through the full foreclosure cycle. So somewhere between summer 2021 and summer 2022 is where you're going to have probably most of the properties that are in distress enter the foreclosure cycle and exit the foreclosure cycle. Here's the opportunity for investors, and here's why it was an interesting time to relaunch RealtyTrac. Prior to the Great Recession, the normal way for a distressed homeowner to get out was to sell a property prior to the foreclosure sale. So you have a borrower gets an initial notice of default. They'll have anywhere from 90 days to 6 months, depending on the state, before the foreclosure auction is scheduled. That gives them a lot of time to try and sell a property. And in the Great Recession, that didn't happen because the market was overbuilt. There was too much inventory. And because of that, prices were falling. So people didn't have any equity. Today's market, there's a record level of equity, $6.5 trillion of equity. According to the numbers at Adam Data, 70% of homeowners have more than 20% equity. So what I do believe will happen is instead of a lot of foreclosure auctions, what you'll see is a lot of distressed property sales in the early stages of the foreclosure cycle. And so it's those borrowers who are in what we call RealtyTrac pre-foreclosure, who will have the opportunity to sell their home, make some money on the sale because the market is so hot right now, and pay off their debt to the bank. And so it's not ideal because they still have to sell their house, but it's much, much better than losing the house to foreclosure. And again, in most of these cases, they'll be able to put money in their pocket as they execute that sale. So, one of the things that, again, that made sense for us to relaunch RealtyTrac at this time was we have all of those early stage notices in our database. So for investors, for real estate agents who are looking to work with those distressed borrowers, we're one of the sources people can go to find those early stage foreclosures and pursue those investment opportunities or pursue those listings if they happen to be an agent.
Interesting. So you're thinking these won't be short sales because partially because of the increase in home values, that they'll be sales where the sellers are still able to make money and pay back their mortgages?
Yeah, again, lenders are extremely reluctant to do a short sale because they're basically
they're long.
So if you're in a market where prices are going up 5% a year and your borrower already has 10, 15, 20% equity, there's no logical reason to ever do a short sale. And if you're the homeowner, you're the borrower, if you can make money on the sale, you'd be foolish to try and do a short sale. It'll destroy your credit, and you're walking away from whatever money you could pocket in the transaction. Again, reality is across the country, there is less than 4 months of supply of homes. In a normal equilibrium stage of the housing market, there's about 6 months. If you're in some markets in California, Austin, the Pacific Northwest, you're looking at less than a month's supply of housing stock. So yeah, again, I think you will see some of those properties come to market from distressed sellers, but I don't think you're going to see as many of them go all the way through the foreclosure process as some people are expecting.
That's really interesting. The idea that we might sort of be able to cut it off at the pass. I think another thing that I'm thinking about too is what happened during the last cycle with institutional buyers. So, uh, you know, build to rent is huge, and single family rentals are huge. I feel like single family rentals are perhaps much more desirable right now with COVID-19 and people being concerned about living with a bunch of people in an apartment building. So, for investors, do you feel like they really kind of have to get ahead of those institutional buyers, and that getting in that earlier stage is a way to kind of uh, basically to compete?
Yes, I do think that for investors, the single family rental market provides some really interesting opportunities. And what's equally interesting is those tenants are continuing to make their rental payments at a higher rate than what we're seeing in multifamily rental units. So it's in the mid 90% range in terms of on-time monthly payments for single family rental properties, which is significantly higher than you're seeing in the multifamily apartment buildings. I have heard anecdotally that some of the institutional buyers are kind of revving up their engines again. They've been relatively quiet for the last couple of years, um, and looking at market opportunities. And to me, that's a sign that individual investors, smaller investors, should be looking at the same thing. The old cliche about follow the money actually does apply here. There are a lot of properties that will be outside of the institutional investors' buy box. They have a lot of money, and they're putting together funds to buy distressed properties, but they don't buy every property. And for example, I know some of them will not touch a property with a swimming pool. They'll have a cutoff in terms of the year built. They'll be looking for properties with a certain number of beds and baths and square feet. The properties that fall outside of those boxes represent really good opportunities for individual investors in the local market. The other thing that is probably worth considering is if you can find out who's doing the buying for an institutional investor in your market, you can get into the wholesale business. You can go tie up a property that meets the buying criteria for that institutional investor, and make basically a finder's fee. And I know that there are wholesale investors out there who are making $5,000 to $10,000 a deal. And while that may not be as much as you get on a fix and flip, if you do it in volume, it can be pretty good money since you're not putting anything out to do the acquisition or the repair costs. I worked with a fix and flip guy in Southern California who was doing about 10 to 12 flips a year, but did 100 wholesales last year instead at 10,000 a clip. So there are opportunities to do that. If you know who the big buyers are in your market, know what they're looking for, you have usually better access more quickly to those local deals. And if you can package them up properly, that can be a pretty lucrative investment strategy as well.
I really like that idea. We haven't talked a lot about wholesaling on Million Acres, but and partly I feel like some of that is because it can feel risky for people, and obviously it requires a lot more knowledge, I think, than people kind of give it credit for, because they think of it as just like finding something and selling it, but it's actually there's so much legwork involved in it.
And you need to be careful with your contracts too. So you need to be working with somebody who knows how to execute those contracts. The gentleman I was talking about a few minutes ago has a contract that basically allows him to tie up the property, but doesn't make him liable for the acquisition of the property in case the deal falls through. And as a wholesaler, that's the kind of protection you want in those deals, so you don't suddenly find yourself on the hook for a $500,000 property that you didn't anticipate buying.
Absolutely. So we talked a little bit about the urban exodus and millennials moving out to suburbs. So one of the things I'm curious about with the foreclosures is, are they going to be in the spots where people are actually going to need them? Another thing that we've been talking about too is, and I know like the New York Times has done stories on this, is the silver tsunami of the baby boomers selling their houses at the same time at the same time, maybe at a different time than millennials are looking, but maybe not in the same markets. Are you feeling like there's going to be a synergy here, or is there going to be there'll be houses where people may not want to be?
Deidre, if I had the answer to that, I'd probably have my book published and be out doing the tours today, wearing a face mask and social distancing appropriately. It's hard to say. Look, here's the reality in terms of what's going on in the market. this is a weird recession because of how it started and what's caused the fallout. In a normal market, you see some economic underpinnings kind of fall off and you have some fundamental weaknesses, and then you have job losses across the board. You have part-time jobs, full-time jobs, and blue collar and white collar, and the Great Recession was very much like that. In this case, there's a handful of industries that really got hit hard: travel, tourism, hospitality, entertainment, retail, restaurants. They tend to be populated mostly by younger workers, by less educated workers, and by lower wage workers. And because of that, most of the workers tend to be renters rather than homeowners. So one of the reasons we haven't seen as much of a fall off in housing as you might have expected with 22 million jobs being lost is that a lot of those jobs were renter jobs. So we're seeing a couple trends going on because of that. We have just now exceeded the prior high in terms of young adults moving home with their parents. Now over 52% of adults under 25 have moved back home, probably due to economic situations. But those jobs that have been lost have not been across the board. And so it's hard to predict exactly where homes will go into foreclosure because of that. The economy went down as quickly as it did because the government basically shut everything down, and our economy, 70% of our GDP is based on consumer spending. So if you shut down everything that consumers could spend money on, your economy is going to go down really quickly, and all those jobs came with it. So it would seem like anybody who was a homeowner in those industries would probably be more likely to be urban or near suburbs than they would be out in the exurbs. But they're, so whether there will be foreclosure activity in the far suburbs, the rural adjacent areas, it seems less likely, but we'll have to let this play out and see what actually happens. Where we could start to see a little bit of foreclosure creep into the suburbs is the businesses that weren't affected by the first wave, but are now being affected because of the economic fallout that it hit all those renters. So you're seeing the airlines announce huge layoffs of personnel. And this is now affecting pilots who actually make pretty good money, and other full-time personnel. So those kind of industries that it's not the second wave of COVID necessarily, but it's the second wave of the recession. We could start to see some of those professionals now find themselves in financial distress, and their properties may wind up coming to market. I'm less concerned about the boomers exiting, in some sort of mass exodus. I love those stories. They come out periodically. First, all the boomers are going to downsize at the same time, so there's going to be a shortage of those kind of houses. And what are we going to do? And now all the boomers are going to leave. And what are we going to do with these McMansions that nobody wants to buy? And it's like, the real world rarely works out the way that it's reported to happen in the New York Times. So I guess that's for better or for worse, but we'll be keeping an eye on it. And I don't think the silver tsunami is going to leave a million vacant properties across the country that nobody wants to buy.
I would agree with that. And certainly the trend, I think the other impact of COVID-19 is going to be that people are going to be less likely to move into senior living or anything like that unless they absolutely have to. And one thing we've already seen is that people are becoming more likely to move their parents in with them rather than sending them to some place like that, or moving in with their parents instead of having them sell their house. So that's another factor.
One of the reasons that stocks like Home Depot and Lowe's have done so well over the last few years is that boomers are opting to age in place. Rather than sell the house they've lived in for the last 20 years, they're working on the house to make it more livable as they age. And so you've seen a lot of investment in that. And the trends you talked about, parents moving in with their kids or kids moving in with their parents, is also happening. You're seeing more multi-generational families or households across the country. So those two things have happened quite a bit. I think there's another investment opportunity, though. I do believe we'll see probably some innovative approaches to senior living as time goes by. I think the notion of the nursing home right now is probably toxic. I don't think anybody wants to touch that. but assisted living communities, senior facilities with more robust healthcare facilities nearby or integrated into the program. I do think you'll see different types of options come to market as the population ages and as a huge percentage of the population ages. It used to be nursing home or live with your kids. And I think just because of the nature of the boomer generation, the amount of money that the generation still has, the fact that they've aged a little bit more healthily than prior generations, I think they're going to be looking for different options. And so I think if I were looking at a market segment that might be a good investment opportunity going forward, different types of senior living facilities might be one I would take a look at.
That makes a lot of sense. One of the things that we're watching as a trend too is that generational wealth transfer and how that's going to impact real estate investing in general. So I want to wrap up with the question I like to ask people is your kind of one tip for real estate investors over the next couple of years.
Wow, that's a great question. I guess I'd say don't believe the hype. The real estate market always operates in cycles, and the people that make the most drastically scary predictions are always the ones that get the most print. And so I tend to take those headlines with a large dose of salt. So keep a long-term perspective on what you're doing, and typically if that's your play in real estate, you're going to come out okay.
Thank you. This was great. I really appreciate your time.
Love to do it again, Deidre. Thank you for having me.
Thank you. Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have a moment, we'd love to hear from you. Please visit millionacrespodcast.pool.com and tell us what you think of the podcast so far, what kind of content and guests you'd like to hear, and what else we can do to help you grow smarter, happier, and richer through real estate. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss, and Millionacres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.